companies confronted with the challenge of putting in place a system. I frankly think they should regard that in the nature of a capital investment, because once you establish it and get it up and in place, the studies have now shown that in subsequent years, the costs decline. Business Week said, despite the grumbling, there's increasing evidence that reform has been well worth the trouble. Already intense scrutiny of accounting methods and internal controls has unearthed lingering problems in the way companies operate. And fixing weak financial controls has nipped a lot of accounting problems in the bud. Nevertheless, I think legitimate concerns have been raised about the costs of compliance, particularly for smaller companies. And to date, the SEC has delayed a full compliance with Sarbanes-Oxley for small cap public companies, those under $75 million market capitalization. They're in the process now of trying to work out, and the SEC and the PCAOB have just issued new guidance, advisory auditing guidance with respect particularly to smaller companies, which is moving away from a heavily rules-based more towards a principle approach, which seeks to take a top-down evaluation of risk, move away from checking every box, crossing every T, and using more judgment in terms of the things to be examined. And by engaging in that process, setting up a more reasonable protocol to be followed in the auditing of the internal financial controls. The statute actually has only 2 little paragraphs about internal financial controls, which, as I said, so much of the attention has been focused. One paragraph says that the management has to report on the effectiveness of the internal control structure. And the other paragraph says that the outside auditor has to attest to the management's report. So it can't be a phony report. I mean, the management can't report we have a very effective system of internal controls when the fact of the matter is they don't. Now, what's required to meet these provisions are not spelled out in the statute, and I don't think they should have been spelled out in the statute. They're left to the regulators to develop. And the regulators are in the process now of trying to do that. They're taking the benefit of the reaction and the further information that they're receiving, and we're hopeful now that we're moving along a path that will address this question in a reasonable way. Chairman Cox, the chairman of the Securities and Exchange Commission, the current chairman, said recently in a speech to the U.S. Chamber of Commerce, and I quote him, "We don't need to change the law. We need to change the way the law is implemented. It is the implementation of the law that has caused the excessive burden, not the law itself. That's an important distinction. I don't believe these important investor protections, which are only a few years old, should be opened up for amendment, or that they need to be." So we tried very hard here to develop a reasonable framework. I am opposed, I want to make it very clear, to unnecessary regulation. But I am for needed regulation. And of course, the critical question is, how do you determine what's needed and what's unnecessary? And for that, I think you have to use a lot of critical analysis and a lot of wise judgment. So we're hopeful that this concern is going to be worked out. I do think the basic requirements just to address the internal control, because that's where most of the controversy has been. I think the basic requirements speak for themselves. I ask you, if someone came to you and wanted you to invest in their company, and you said to them, well, I might be interested, how's your system of internal financial controls? And the person said to you, oh, we don't have a system of internal financial controls. We don't believe in such a thing. We think it's too much of a burden. It's an example of over-regulation, so we don't bother with internal financial controls in our company. I doubt very much you would invest your money in that company. And of course, the whole thrust of Sarbanes-Oxley was to assure the investor that the reports they were receiving on the financial condition of companies were transparent, were honest, were accurate, were information they could rely upon in order to make investment decisions. And what we saw happen was when investors confronted a situation in which they had been misled, in effect lied to by major corporations, they began to flee the capital markets. And we paid, a very heavy There are people in the United States who thought their retirements had been well provided for, who found themselves in difficult circumstances. Now, there are a lot of other developments that are taking place with respect to corporate governments that do not come specifically out of Sarbanes-Oxley. But we get blamed for everything that's going on. Actually, if you go home this evening and your spouse begins to fuss at you and complain with you, just say, it's Sarbanes-Oxley that did it. I said that to one group. A young woman came up after. She says, you couldn't have been more right. She says, in our company, she says, when the water fountain doesn't work, and someone says, what's wrong with a water fountain? And the answer is, it's Sarbanes-Oxley. So, the other issue I want to touch on very quickly, and this is more a criticism that arises in the U.S., but it has implications worldwide, is the assertion that our competitiveness as a capital market has been seriously impeded by this legislation or other legislation designed to assure high corporate governance standards. And they point to the fact that capital markets are developing elsewhere in the world, and they say, well, it's a flee from this regulatory environment. There may be a little bit to that, but I think, as many commentators have said, that essentially what you're seeing happen is for decades people have been urged to develop capital markets worldwide. In every country, as they seek to move their economy forward, you say, well, you need a good, effective, strong capital market to help fuel your economic growth. Well, people are doing exactly that. Secondly, with the economic growth that's taking place worldwide, and I would submit particularly in Asia, the economic wherewithal, the capital and the liquidity for these capital markets to function elsewhere. So in a sense, globalization, which has always been referenced to manufacturing, is working in the financial services industry as well. So I don't think it's reasonable for New York to expect that the capital markets are going to be as prominent worldwide as they were at an earlier time, because there's economic growth elsewhere, market maturation, which provides for competitors. The real question becomes, at what level does this competition take place? And on that score, I'm encouraged by the fact that there does not seem to be a race to the bottom internationally